Most people think the story of gold and silver begins with a chart, a breakout, a price target, a prediction. It does not. It begins much earlier, in a place far less visible. It begins when confidence stops feeling automatic, not collapsing, not panicking, just thinning, quietly, invisibly. In late 2025 and early 2026, there will be no headline announcing a reset, no emergency broadcast, no official admission that something fundamental has changed. What people will feel instead is confusion. A growing sense that the numbers no longer match reality, that paychecks rise slower than costs, that debt keeps growing even when economies are not officially in crisis, that governments keep borrowing even when growth is described as strong. That contradiction is the signal most people are trained to ignore. The idea that gold at $6,000 or silver at $100 sounds extreme only makes sense if you believe money itself is stable. History does not support that belief. Money is not stable. It is managed, and management always comes with a cost. According to the International Monetary Fund, total global debt surpassed $300 trillion in the mid-2020s. That figure represents more than 3 times global economic output. There is no historical precedent for debt at that scale during peacetime. Debt like this is not paid down. It is rolled forward, refinanced, diluted slowly through inflation and currency expansion. In the United States, federal debt has exceeded $36 trillion, while annual budget deficits remain above $1 trillion, even outside recessionary periods. These figures are published openly by the United States Treasury. What matters is not the shock value of the numbers. It is what they imply. High debt levels narrow policy choices. They make sustained high interest rates economically painful. When debt servicing costs begin to compete with basic government functions, pressure builds for easier financial conditions. That pressure does not disappear. It expresses itself through currency value. This is where gold enters the conversation, not as a speculative trade, but as a reference point. Gold does not measure growth, it measures trust. Over the last several years, central banks around the world have been consistent net buyers of gold. Data published by the World Gold Council shows central bank purchases exceeding 1,000 metric tons in multiple recent years. Central banks do not chase trends. They manage reserves. When institutions responsible for currency stability increase gold holdings, they are hedging long-term confidence risk, not reacting to short-term price movements. At the same time, real interest rates remain historically constrained. Even when nominal rates rise, inflation has proven persistent. Data from the Federal Reserve and official inflation indices show that periods of clearly positive real yields have been brief and unstable. This matters because when real yields cannot remain convincingly positive, holding cash and bonds quietly loses purchasing power. In that environment, gold stops being compared to yield and starts being compared to credibility. Silver operates under a different but connected logic. Unlike gold, silver lives in 2 worlds at once. It is monetary and industrial. According to data published by the Silver Institute, more than half of annual silver demand now comes from industrial uses. These include electronics, solar energy systems, medical technology, and electrification infrastructure. Much of this silver is consumed permanently. It is not efficiently recycled. Supply, meanwhile, grows slowly because silver is primarily produced as a byproduct of copper, lead, and zinc mining. You cannot simply decide to produce more silver because the price rises. This creates a structural sensitivity. When industrial demand rises while monetary demand begins to awaken, silver does not adjust smoothly. It reprices in bursts. Historically, during periods of monetary stress, silver has lagged gold early and then moved much faster once confidence begins to break. This is why silver is often labeled volatile, not because it is broken, but because it is small, essential, and emotionally misunderstood. Another important signal is the gold to silver ratio. Throughout history, extreme ratios have tended to appear during periods of monetary stress and distorted pricing. When those distortions resolve, silver has often outperformed gold as the ratio compresses. This process is rarely linear, and it reflects a market recalibrating scarcity under changing confidence conditions. Geopolitics adds another layer. Global supply chains are no longer treated as neutral. Trade restrictions, strategic stockpiling, and resource nationalism have become policy tools. Markets do not require permanent shortages to react. They only require uncertainty. Uncertainty raises risk premiums. Risk premiums change how scarce assets are priced. One of the most persistent misconceptions is that gold and silver require collapse to perform. They do not. Historically, they have performed best during long periods of financial repression. This is when interest rates are held below inflation to manage excessive debt burdens. This is not theory. It is a documented policy approach used repeatedly throughout modern history. Financial repression reduces the real value of debt while quietly eroding savers' purchasing power. Gold and silver sit outside that mechanism. They do not stop inflation, they expose it over long cycles. They reflect dilution rather than drama. That is why large price targets feel unrealistic to people anchored to recent history. Anchoring is costly. It assumes the measuring unit stays constant while the system behind it changes. Silver follows a similar logic, but with an added layer of complexity. According to research published by the Silver Institute, more than half of annual silver demand now comes from industrial uses. These include solar panels, electronics, medical devices, and electrification infrastructure. Much of this silver is consumed and not economically recoverable. At the same time, global silver supply growth remains limited because most silver is produced as a byproduct of base metal mining. Supply does not respond quickly to higher prices. This structural mismatch makes silver particularly sensitive to changes in demand. When monetary interest in silver overlaps with tightening industrial supply, the market does not adjust gradually. It compresses and then releases. This is why silver historically lags gold during the early stages of monetary stress and then moves much faster once confidence begins to erode. The volatility that follows is often mistaken for manipulation. In reality, it reflects imbalance in a small and essential market adjusting to new conditions. Another overlooked signal is reserve diversification beyond gold alone. Many emerging market central banks have been reducing reliance on dollar-denominated assets while increasing exposure to tangible reserves. This behavior reflects a more fragmented global financial system where neutrality matters. Gold carries no counterparty risk. It is not dependent on any government or institution to function. That quality becomes more valuable during periods of geopolitical tension, trade disputes, and financial sanctions. These conditions do not need to escalate into crisis to influence reserve strategy. They only need to persist. At the same time, fiscal realities continue to tighten. In the United States, Treasury data shows persistent budget deficits even during periods of economic expansion. This indicates that borrowing has become structural rather than cyclical. Structural deficits require continuous financing. Continuous financing increases reliance on accommodative monetary conditions. Accommodation does not always appear dramatic. Often it takes the form of tolerance for inflation running slightly above official targets for extended periods. That tolerance gradually erodes purchasing power rather than destroying it suddenly. This slow erosion is why gold and silver are frequently misunderstood. They are not crisis assets, they are long cycle assets. Historically, they perform best not during panic, but during extended periods where inflation remains above comfort levels and policy options remain constrained. Economists often describe this environment as financial repression. Interest rates are held below inflation to manage debt burdens. Savers bear the cost. Assets tied to scarcity adjust upward. Viewed through this lens, the idea of gold reaching $6,000 or silver reaching $100 becomes less shocking. These are not predictions of collapse. They are scenarios that become plausible when the measuring unit loses value. A higher metal price does not necessarily mean metals have changed. It often means the currency used to measure them has weakened. This is where behavior becomes decisive. Many participants lose money in precious metals not because the thesis is wrong, but because expectations are misaligned. Metals do not move in straight lines. Pullbacks are normal. Volatility is structural. Chasing headlines and reacting emotionally turns a protective asset into a speculative mistake. Gold is best understood as a trust indicator. Silver is best understood as a stress amplifier. Gold reflects declining confidence in long-term policy, credibility. Silver reflects that same decline colliding with real-world demand constraints. When both signals align, repricing accelerates. As the timeline approaches 2026, the backdrop remains defined by elevated debt, constrained policy, persistent inflation pressure, and shifting reserve behavior. None of these forces require dramatic escalation to remain influential. They only require time. Time is the variable markets consistently underestimate. When people fixate on price targets, they miss the structure. When they understand structure, price becomes a consequence rather than a surprise. What ultimately determines whether gold and silver reprice sharply is not emotion, speculation, or headlines. It is arithmetic. When debt grows faster than productive output, systems encounter limits that cannot be managed indefinitely through communication or reassurance. Data tracked by the International Monetary Fund shows that advanced economies are now carrying debt loads that were historically associated with major wars. The difference today is that these levels persist during peacetime. That persistence fundamentally changes how money behaves over time. Highly indebted systems depend on refinancing. Governments roll debt continuously. Corporations refinance liabilities. Financial markets operate under the assumption that liquidity will remain available at tolerable rates. This assumption holds until it does not. When interest rates rise too far, debt servicing costs escalate rapidly. When rates are held too low, inflation quietly erodes purchasing power. Policymakers are forced to choose which form of pressure is less destabilizing. Historically, inflation has been the path of least resistance. This reality explains why real interest rates matter more than nominal ones. Nominal rates can rise while still failing to protect purchasing power if inflation remains persistent. Data from the Federal Reserve shows that in recent years, periods of clearly positive real yields have been short-lived and unstable. Markets sense this instability. When investors believe real rates are capped by debt constraints, the opportunity cost of holding gold declines. That is the moment gold changes role. It stops being compared to yield and starts being evaluated as credibility. Gold does not require inflation to spiral out of control. It only requires inflation to outlast confidence in policy responses. In such environments, gold historically reprices over time, not through sudden explosions, but through cycles of consolidation followed by acceleration. These phases are often mistaken for failure by those expecting immediate validation. In reality, they represent digestion as the market adjusts to new monetary realities. Silver enters this dynamic later and with greater force. According to supply and demand research published by the Silver Institute, global silver supply growth has struggled to keep pace with rising industrial demand. Electrification projects, renewable energy infrastructure, electronics manufacturing, and medical technologies all rely heavily on silver. Much of that silver is consumed permanently. At the same time, new mine supply responds slowly because silver is primarily produced as a secondary output of base metal mining. This creates a structural imbalance that cannot be resolved quickly. When monetary demand for silver overlaps with industrial tightness, the market does not reprice smoothly, it gaps. This explains why silver has historically lagged gold during early stages of monetary stress and then overshot once recognition spreads. The volatility is mechanical, not emotional. It reflects a small market adjusting rapidly when pressure can no longer be absorbed quietly. Another often overlooked factor is the relative size of the silver market compared to global financial assets. Silver is tiny relative to equities and bonds. This means even modest shifts in allocation can have disproportionate price effects. When capital rotates quietly rather than all at once, price becomes the adjustment mechanism. Large percentage moves in silver are not necessarily signs of speculation. They are signs of thin liquidity meeting real demand. Gold behaves differently because its market is deeper and its role more explicitly monetary. Data from the World Gold Council shows that central banks have increased gold purchases meaningfully over recent years, adding hundreds of tons annually to reserves. This behavior reflects strategic balance sheet management, not short-term trading. Central banks accumulate gold to achieve neutrality, diversification, and insulation from currency risk. This institutional demand matters because it is far less sensitive to price fluctuations than retail demand. When reserve managers buy gold, they are not reacting to pullbacks. They are reallocating long-term assets. That creates a baseline level of demand that did not exist in earlier cycles. Supply growth, meanwhile, remains slow and capital intensive. Mines take years to develop. This imbalance does not guarantee higher prices, but it increases sensitivity to shifts in confidence. The idea that gold reaching $6,000 means gold itself has become extraordinary misunderstands how repricing works. Historically, large increases in gold prices have often reflected changes in the measuring unit rather than changes in the metal. Currency purchasing power erodes gradually until repricing becomes unavoidable. When that adjustment occurs, prices move to reflect reality rather than enthusiasm. Silver at $100 follows the same logic, but with greater amplitude. Because silver spent long periods undervalued relative to gold, repricing can compress into shorter time frames. Catch-up movements feel sudden because recognition arrives late. This is why silver is often dismissed until it becomes impossible to ignore. The greatest risk for most participants is not that gold or silver fail to perform. It is that they approach them with expectations shaped by short-term market behavior. Precious metals are not designed to deliver constant excitement or predictable quarterly gains. They are designed to preserve purchasing power across long cycles defined by debt expansion and constrained policy. As the system moves closer to 2026, the backdrop remains dominated by high global debt, limited policy flexibility, persistent inflation pressures, and shifting reserve strategies. None of these forces require collapse to continue influencing markets. They only require time. Time allows structural imbalances to express themselves gradually through repricing, rather than abruptly through crisis. Gold and silver are not expressions of fear. They are responses to math. And math does not care about narratives, forecasts, or reassurance. It responds to ratios, incentives, and constraints. When people ask whether $100 silver or $6,000 gold is possible, the honest answer is that price is not the correct starting point. Conditions are. When conditions align, prices follow. That alignment does not announce itself loudly. It unfolds quietly, then unevenly, then suddenly. By the time the move feels obvious, it has already been years in the making. Understanding that sequence is the difference between reacting late and positioning early. What ultimately separates people who benefit from long monetary shifts from those who do not is not intelligence or access to information. It is time horizon. Most participants are trained to think in weeks and months, while gold and silver respond to forces that operate over years. That mismatch creates impatience. Impatience leads to emotional decisions, and emotional decisions are how long cycle assets punish people who are otherwise directionally correct. History makes this pattern clear. During the 1970s, gold did not rise because of a single shocking event. It rose because inflation persisted while policy credibility eroded gradually. Real interest rates stayed negative for extended periods. Purchasing power declined year after year. Gold responded not explosively at first, but persistently. Silver followed later and with far greater volatility, eventually overshooting as recognition spread. The process was uncomfortable, uneven, and frustrating for most participants at the time. A similar pattern emerged after the global financial crisis. Central banks suppressed interest rates for more than a decade. Balance sheets expanded dramatically. Asset prices rose across equities and real estate, yet purchasing power erosion continued quietly beneath the surface. Gold peaked, corrected, consolidated, and then resumed its role as a hedge once inflation returned with force after 2020. The move was not linear. It never is. Long cycle assets do not reward impatience with smooth confirmation. What matters now is that the global system has entered another phase where policy flexibility is limited. Data published by the Bank for International Settlements shows that debt servicing sensitivity has increased significantly across both public and private sectors. Even modest increases in interest rates now have outsized effects on budgets, corporate balance sheets, and financial stability. This reality reinforces a structural bias toward accommodation rather than austerity. Accommodation does not always appear as dramatic easing. Often it appears as tolerance for inflation running above targets for longer than publicly acknowledged. Silver at $100 follows the same logic, but with greater amplitude. Because silver spent long periods undervalued relative to gold, repricing can compress into shorter time frames. Catch-up movements feel sudden because recognition arrives late. This is why silver is often dismissed until it becomes impossible to ignore. The greatest risk for most participants is not that gold or silver fail to perform. It is that they approach them with expectations shaped by short-term market behavior. Precious metals are not designed to deliver constant excitement or predictable quarterly gains. They are designed to preserve purchasing power across long cycles defined by debt expansion and constrained policy. As the system moves closer to 2026, the backdrop remains dominated by high global debt, limited policy flexibility, persistent inflation pressures, and shifting reserve strategies. None of these forces require collapse to continue influencing markets. They only require time. Time allows structural imbalances to express themselves gradually through repricing rather than abruptly through crisis. Gold and silver are not expressions of fear. They are responses to math. And math does not care about narratives, forecasts, or reassurance. It responds to ratios, incentives, and constraints. When people ask whether $100 silver or $6,000 gold is possible, the honest answer is the price is not the correct starting point. Conditions are. When conditions align, prices follow. That alignment does not announce itself loudly. It unfolds quietly, then unevenly, then suddenly. By the time the move feels obvious, it has already been years in the making. Understanding that sequence is the difference between reacting late and positioning early. What ultimately separates people who benefit from long monetary shifts from those who do not is not intelligence or access to information. It is time horizon. Most participants are trained to think in weeks and months, while gold and silver respond to forces that operate over years. That mismatch creates impatience. Impatience leads to emotional decisions, and emotional decisions are how long cycle assets punish people who are otherwise directionally correct. History makes this pattern clear. During the 1970s, gold did not rise because of a single shocking event. It rose because inflation persisted, while policy credibility eroded gradually. Real interest rates stayed negative for extended periods. Purchasing power declined year after year. Gold responded not explosively at first, but persistently. Silver followed later and with far greater volatility, eventually overshooting as recognition spread. The process was uncomfortable, uneven, and frustrating for most participants at the time. A similar pattern emerged after the global financial crisis. Central banks suppressed interest rates for more than a decade. Balance sheets expanded dramatically. Asset prices rose across equities and real estate, yet purchasing power erosion continued quietly beneath the surface. Gold peaked, corrected, consolidated, and then resumed its role as a hedge once inflation returned, with force after 2020. The move was not linear. It never is. Long cycle assets do not reward impatience with smooth confirmation. What matters now is that the global system has entered another phase where policy flexibility is limited. Data published by the Bank for International Settlements shows that debt servicing sensitivity has increased significantly across both public and private sectors. Even modest increases in interest rates now have outsized effects on budgets, corporate balance sheets, and financial stability. This reality reinforces a structural bias toward accommodation rather than austerity. Accommodation does not always appear as dramatic easing. Often it appears as tolerance for inflation running above targets for longer than publicly acknowledged. This environment quietly reshapes portfolio behavior. When investors begin to lose confidence in bonds as reliable protection and question the long-term purchasing power of cash, diversification strategies change. Gold benefits from this shift not because it produces income, but because it carries no counterparty risk. It does not depend on policy discipline or institutional promises to function. That independence becomes more valuable as trust becomes conditional rather than assumed. Silver's role becomes clearer later in the cycle. As industrial demand continues to expand through energy transition projects, electrification, and technology infrastructure, silver consumption rises regardless of monetary conditions. Industry data shows that a large portion of silver used in these applications is not economically recoverable. This creates a steady drawdown on available supply. When monetary demand begins to overlap with this trend, price becomes the only mechanism that can balance the market. This is why silver historically behaves in bursts. Long periods of stagnation create the illusion of irrelevance. Then conditions align and repricing compresses into short time frames. These moves feel shocking, not because they are unnatural, but because recognition arrives late. Markets rarely reward patience with gentle outcomes. They reward it with discontinuity. Another factor that consistently traps participants is psychological anchoring to recent price history. When people say that $6,000 gold or $100 silver feels unrealistic, they are often anchoring to a monetary regime that no longer exists. Monetary systems change slowly, then decisively. When the unit of measurement weakens, asset prices adjust upward, not because assets become extraordinary, but because the yardstick shrinks. This is why focusing on nominal price targets can be misleading. A higher metal price does not automatically mean greater real wealth. In many cases, it reflects preservation rather than gain. Gold and silver are not tools designed to outperform productive assets in healthy systems. They're tools designed to preserve purchasing power when systems rely increasingly on debt and policy intervention. As this cycle matures, volatility should not be mistaken for failure. Pullbacks, consolidations, and sharp corrections are part of the process. They reset positioning, they remove leverage, they transfer ownership from weak hands to strong ones. Historically, the strongest advances in precious metals have followed periods where sentiment was frustrated, not euphoric. The key insight is that gold and silver do not require perfection to perform. They require imbalance. They require uncertainty that lingers long enough to change behavior, That uncertainty is already present in debt trajectories, policy constraints, and reserve management decisions. None of these forces need to accelerate dramatically to remain influential. They only need to persist. As the decade progresses, the metals market will continue to challenge expectations. It will test patience, it will punish emotional positioning, and it will reward those who understand that long cycle assets do not move to entertain. They move to reflect reality once confidence can no longer be maintained by narrative alone. The final piece of this story is not about prices, it is about perspective. Gold and silver do not exist to predict the future or to provide constant excitement. They exist to reflect reality when confidence in systems becomes conditional rather than assumed. Over long cycles, they act less like trades and more like mirrors. They show what happens when debt grows faster than productivity, when policy choices narrow, and when purchasing power erodes quietly rather than catastrophically. What history keeps proving is that repricing does not require disaster. It requires persistence. Persistent deficits, persistent refinancing, persistent inflation pressure that policy struggles to contain without creating new problems elsewhere. In that environment, trust does not vanish overnight. It thins. And when trust thins, capital does not panic. It reallocates. That process is slow at first and then decisive. This is why most people experience these shifts emotionally backward. They ignore them when they are quiet and chase them when they are loud. By the time consensus forms, the structure has already changed. Long cycle assets reward those who understand why they exist, not those who demand constant confirmation. Gold preserves credibility. Silver amplifies stress. Together, they respond to math, not messaging. If this perspective helped you see gold and silver differently, share it with someone who still thinks price targets alone tell the story. Most people are taught to watch charts, very few are taught to watch conditions, and conditions are what actually move markets over time. If you want more calm, evidence-based breakdowns like this, support the channel by liking the video and subscribing. Not for hype, not for predictions, but for clarity in a system that rarely explains itself honestly. Because when the next phase becomes obvious to everyone, preparation will no longer feel boring. It will feel late.